Hey everyone, and thanks for joining me today. My name's Matt, and if you saw my video from yesterday, then you know I did a stock analysis for my Watchlist Wednesday on Square and PayPal. And I ultimately ended up choosing to purchase an ETF instead. And I know I didn't explain it really yesterday just for sake of time for that video, but I wanted to make a follow-up video today to explain why I ultimately ended up choosing an ETF instead of picking one of those two stocks or even buying both of them. So let me play a quick intro there and we'll go ahead and get right into this. So I want to start off by explaining why I chose an ETF instead of those two, and then I'll explain why I chose specifically that ETF. Now, the reason why I chose to pick an ETF instead of picking one of the two stocks or even buying both of them is because while both PayPal and Square are great companies, and ultimately I do feel for the long run they're probably really good investments, they're not my favorite when it comes to payment methods. Ultimately, I prefer payment methods like Visa and MasterCard over those, just because they pay a dividend, they're less aggressive of a stock, so they're an income-producing investment, and they're less volatile. And I think during times like this, it's really important to be able to manage your risk that you have in the account and get exposure to multiple different areas so that way you're not hyper-focused on one sector or have a bunch of aggressive investments inside of your portfolio. So to date, I do have some fairly aggressive investments in my Watchlist Wednesday portfolio. The two most notably, I would say, though, would be the Peloton as well as Shopify for the account. So I really didn't want much more exposure to something that's aggressive or could be providing a loss relatively quickly. So that's why I chose an ETF, and the reason being is I chose that ETF, or part of the reason why I looked at those is because the ETF that I chose, VGT, Vanguard's Information Technology, is because it has both PayPal and Square as investments, and actually PayPal is one of the top 10 investments or top 10 largest holdings in that fund, as well as it has Visa, MasterCard, and some other payment processing systems, as well as other investments in there and other kind of information technology systems. So to me, it made a lot more sense. Instead of trying to buy Visa, MasterCard, PayPal, and Square, that would have been really expensive, and it would have cost more than it did for me to buy a few shares of this ETF. And so to me, that's where it adds up, and that's why I'm always a big fan of ETFs, because it allows for you, for the price of a stock, you can purchase hundreds of funds or hundreds of different positions inside that ETF. So to me, that's what just makes sense because, at the end of the day, yes, I went to college for finance. I worked in finance for many years. I was definitely that nerd that even while I was working in finance was just always looking into different funds and investment products or different stocks. But picking stocks to me can a lot of times feel like I'm gambling. And when it comes to my money, sure, gambling's all right, but I'm that person that would walk into a casino and go to the cheapest table that they have with the easiest game. If I lose my money, I'm done. I don't like throwing money around like that, and so I feel when it comes to investing, I'd rather play it a little smarter and have something that's more diversified, and push comes to shove, I will leave that up to the experts. Somebody's getting paid to manage these portfolios, put them together, and track the performances and everything like that. I simply don't have the time to look at that many different stocks, do analyses, and put it all together in a portfolio. I can do about one a week, but these have hundreds of positions inside of them, and that takes a lot of time. So I don't feel like I'm personally in a position or have the knowledge to say that a fund director or fund manager is wrong and I can do a better job. I might be able to, and I've done pretty well with stock picks in the past, but ultimately, I would always say to people when I was working in finance, you can't create time for yourself, but what you can do is create value for yourself. So if you have the ability to take something off your plate and let a professional handle it, that's just as good as buying yourself more time. And that's how I always look at it. So yeah, I like looking at stocks. It's something I do on my free time. But when it comes to my more serious investments, which is what I'm trying to transition the Watchlist Wednesday into, is more serious investments, then I'm going to be looking at more ETFs and hopefully have a better outcome over the long term than I would by picking individual securities. So that's why I chose that as the investment for yesterday. That's why I decided to go with an ETF. But now let me explain why I chose VGT specifically over some of its peers. So you can see here the funds that I decided to take a look at was the Vanguard fund, the VGT. We have the Fidelity Fund, FTEC, an Invesco fund, RYT, as well as an iShares fund, IGM. So these are all information technology ETFs. Now they don't track the same benchmark. A little bit more on that later, but just so you know, these don't all track the same benchmark. The Vanguard and the Fidelity one do track the same benchmark. And again, we'll talk more about that later. What I do is I like to break everything down onto a spreadsheet like this. And yeah, it's available like this on the internet, but I kind of like just making my own, even if I'm just copying and pasting the information, because it allows for me to kind of play around with it. And it's just easier. You know, I have a way I like to see this that makes it easier for me to follow along with. So all I did was take this information from Seeking Alpha and put it onto the spreadsheet, so nothing fancy there. We can see that when it comes to expense ratios themselves, these are all pretty low expense ratios. As long as it's below 0.5, that's okay with me for an ETF. And to see that the Vanguard one is actually not the cheapest, the Fidelity one is cheaper. So usually that's a big indication for me. Now, I'm not going to sweat over 0.02% the way that I might over 0.36%, but you know, that's why we have to take more of a look at this into, you know, is it worth paying that extra amount in an expense ratio, and will the performance make up for what you've lost in paying those expenses? And so generally expense ratios is the first place I look when I look at investing in ETFs, as well as the top holdings in the fund itself, just to make sure that they're all competitive and all on the same page when it comes to what they're investing in. That's what I'll look at first, and just make sure that immediately before I get myself excited, this isn't a fund I'm going to overpay for. Now we can clearly tell though, AUM, assets under management, so that's how much money is actually in these funds themselves for the investments and buying all these different shares. And this is in billions, and we can clearly see that the Vanguard one is the largest. It's not really a surprise to me because Vanguard's known for their ETFs and whatnot, but it is pretty amazing how much larger it is than these other ones. And that just always makes you kind of question or ask, does it have anything to do with, you know, Vanguard's background, their credibility? What are they maybe doing differently that other people are not doing? But we can just see that this Vanguard fund is very large. And so a lot of people are clearly trusting this fund with their money. When it comes to the dividend yield, again, you know, it's pretty competitive here. The only one that stands out to me as maybe a loser in this situation is going to be the iShares fund. Nothing crazy, but you know, ultimately when I looked at these numbers, the only thing that stood out to me as something potentially exciting would be the 5-year performance, but more on that when we get to that. So dividend yields, these all pay quarterly dividends. They all pay dividends at the same time, which is going to be your March, June, December, and September is when he would get a dividend. So it's not one that you can really build a ladder on top of and try to maybe, instead of getting quarterly dividends, try going for every other month or something along those lines. So bear that in mind as well. Now, what really got me excited though there's a few things that got me excited about the Vanguard fund. First one is this dividend growth rate. That is a substantial growth rate for a dividend. Now that's not what got me most excited, but that is certainly something that catches my eye as the investor, because this is something I want to know. As I'm investing in it, are they going to continue to produce more and more income for me? And the reason why that's beneficial is because if you reinvest dividends, I've talked about this in my Vanguard real estate investment, but if you reinvest these dividends, then ultimately your position is going to get larger and larger and larger. So, you know, you start off with 5 shares. Over time, that can grow to 6 shares, and then the 6 shares is going to even more quickly get to 7 shares, so on and so forth. So on top of you having a larger position, the amount that you'll receive from these dividends or payouts is also going to increase. So you're getting more because you own more shares, and you're getting a larger dollar value just because they're very rapidly increasing their dividend growth. Over the 5-year performance, I thought this was pretty okay. You know, I mean, 168% is definitely a good thing to see. And now I want to pause here because we can see that the Vanguard performance is a little bit lower than what it is for the iShares one. Not by much, fraction of a percent. But the reason why I would choose the Vanguard one over the iShares one in this case is because of the expense ratio. So personally, the 0.36% higher expense ratio does not make up for the 0.05% higher return over those. I think that's a 5-year performance. So that's something you have to look at with these expense ratios is if a fund does have a higher expense ratio, does it also have a higher performance? And does that higher performance actually make up for the higher cost? Because that is, I want to say the tricky part, but it's also kind of the easier part when it comes to investing in ETFs. That was very contradicting, but you have to pay very close attention to cost. You don't have to worry about that in stocks because you don't pay expense ratios on stocks. There's nobody actually managing that stock for you. You're doing that on your own. So it is important when you look at returns, again, just be cognizant of the fact that they might be charging more, and does that really balance out for you as the investor? So the next thing to take a look at here is going to be the number of holdings in this. It's kind of a slap in the face from Fidelity just to add one extra position to theirs. So one extra stock is not going to make or break a performance for me. But to me, seeing the Invesco one with only 73 positions in it is incredibly low. And so it just kind of makes you wonder. Now, yes, we could consider that maybe it's because it has less assets under management in that fund, so they can't afford 300 stocks in there. But considering it's, the iShares one is not even double the amount of assets under management than the Invesco one, and it has way more than double holdings inside of it. Personally, if I was picking between those two, I'd choose the iShare ones because it's more diversified, has more assets under management, and that's about it. That might be the only reason why I would choose that, but anywho, a little bit of a tangent there. So I like to see the number of holdings, and I always like to compare that to the peers because it seems like 300 and up for this information technology sector is the norm. And so seeing something like 73 is definitely going to be a red flag to me. If that was a fund I was very seriously considering, then I would look into why there's so many or so little amount of actual positions inside of that compared to its competition. Now, the last thing that really stood out to me for the Vanguard fund and why I made this decision is because of the turnover ratio, which is 5% for Vanguard. I've talked about this before, and I'll actually say, so tomorrow what I'm thinking of doing is making a video explaining ETFs because there is a lot to know. So sorry if I'm kind of brushing over some key details here. I'll talk more in detail about that in another video. But a 5% turnover ratio is a great thing to see, especially compared to 27 or 18%, because basically a turnover ratio means how many times assets are bought and sold within that fund. The less frequent it is, the better, personally, I believe. And kind of it speaks for itself here because the performance for the Vanguard fund clearly does almost the best out of all of these, and it has by far the lowest turnover ratio. The one doing the best is the iShares one, in theory, and it has an 8% turnover ratio. So these fund managers are not going through and frequently changing the stock positions inside. They're really following the benchmark that they're lined up to, making occasional adjustments to these, but nothing crazy and nothing too frequently, because again, that kind of goes against the Bogle's theory of long-term buy and hold and just ride it out. Also, too, as the investor, something that's commonly overlooked, and again, we'll talk more detail about this in another video, but if a ETF or mutual fund has a high asset turnover ratio, that means you as the investor are going to be taxed on that turnover ratio. So these aren't necessarily the most tax efficient investments when it comes down to it. Let me put it this way, actually. So you own a fund, you bought shares of McDonald's and this price is completely made up. You bought it at $100, you sold it at $50. You'd have a $50 capital gain. So that'll be in your personal account. Let's say it's the same thing in the ETF. The ETF had McDonald's experience the same gains and they sell out of it. Well, anybody that owns that ETF, the capital gains are going to be passed down to you. Now, you can't avoid this if you look into a retirement account, since those are tax efficient. Long story there. But if you are investing just for yourself, and this is in just an individual or maybe a joint account that you have, pay attention to the low asset turnover ratios, because that's what's going to make this a more tax efficient investment for you. And again, too, as we kind of see, again, the proof is in the pudding, that having a lower turnover ratio, for the most part, and from what I've seen, actually benefits the performance of the fund. And so for those reasons, so having the high dividend growth rate, lower expense ratio, better performing, and low asset turnover ratio are the reasons why I chose the Vanguard fund over other ETFs. And again, it does include exposure to PayPal, Square, Visa, and MasterCard, which are funds that are positions that I was looking to get into anyway. And so rather than breaking the bank trying to buy 5 shares of each of those and costing thousands of dollars, I just bought a few shares of the ETF. And I got exposure to other companies like Salesforce and Microsoft. So I'm a big believer in ETFs. I can harp on this for a very long time, but I hope that gave some clarification as to why I added the ETF to the fund, and specifically VGT to the portfolio, or to the Watchlist Wednesday portfolio. If you have any questions on that, please let me know. Like I said, I'm going to try to make a video tomorrow that goes over in a little bit more detail about investing in ETFs. Then maybe down the road I'll do a video comparing stocks to ETFs. But it's pretty easy stuff. There's a few things I want to make clear, but for sake of time in this video, I'm going to cut it short. So I think with that said, you now know why I chose VGT. If you have any questions, let me know in the comments down below. If possible, try to let me know today so I can maybe include that for tomorrow's video, or maybe I'll hold that off to Saturday. We'll just see. If you thought this video was helpful though, or informative, I'd really appreciate if you gave it a thumbs up. If you like this kind of content and you wanted to subscribe, that'd be super awesome. We broke 100 and I'm so appreciative of that, but I don't want to stop there. I love watching this channel grow. Every time I get a new subscriber, it just motivates me more and more to keep pushing forward. And when I have the days where it just jumps pretty dramatically, then I get very excited and end up making multiple videos that week. So thank you to everyone who's bared with all my stuttering and nonsense over these past few videos, and thank you for subscribing to my channel. Again, if you haven't already, just consider doing it. You don't have to today, but maybe the next time you come across one of my videos, give it a consideration. Well, you can be anywhere in the world, but you're right here with me, and I really appreciate that. So thank you so much for taking the time out of your day to watch this video. I will let you go ahead and enjoy the rest of your day, and we'll see you next time.